Well, good morning. This is Dennis Hammond from SandPointe Asset Management. This is our webinar, Is Vol Dead? It's 11:15 a.m. Eastern Standard Time on November the 16th, and we want to welcome you today to our first ever webinar. I like to start off with something funny, so I thought I might share with you November's top 3 VIX joke. I bet you haven't heard a VIX joke recently. So in ascending order, here we go. In third place, we have, what's the difference between the VIX and a roller coaster? Answer, seat belts. In second place, we have, how is the VIX like strong coffee? Answer, both will keep you up at night. All right, I'm going to save the third one for the end and get started now. We, again, want to welcome you to our webinar, Is Vol Dead? Tricia and I will try to speak to that and give you SandPointe's best thinking. We do appreciate your kindness and interest in dialing in, and we will send you by email a copy of the slides at the conclusion of our remarks again today. But again, thanks for attending. As many of you know, this has been a year unlike any other. If you'll recall, July 21st, the VIX index closed at 936, its lowest close since December 1993. You'll recall that was Bill Clinton's first year in office. That was 24 years ago. Then on November 3rd, the VIX index closed at 914, the lowest closing value since the index began in 1990, 27 years ago. In fact, of the 10 lowest VIX closes in history, 8 have occurred in 2017. The other 2 were just before Christmas in 1993. Out of the 20 lowest VIX closes in history, 18 have actually happened this year. One of the most startling facts that I found is this. Since its inception in 1990, over 27 years, the VIX has closed below a level of 10 only 49 times. So out of those thousands of days, there's been a level of 10 or lower closing below a level of 10, only 49 times. Surprisingly, 40 of those have been in this year. Investors are wondering, is volatility dead? And we think that's a great question. Let me start by introducing myself. Again, I'm Dennis Hammond. I'm the CEO and CIO of SandPointe Asset Management. We're a quantitative U.S. volatility manager. I was previously the CEO and founder of Hammond Associates, who you may know is one of the second largest investment consulting firms in the United States to higher education and foundations. We had about $55 billion in AUM, or AUA rather, when I sold the company to Marsh Mack, and a few billion in AUM. Our company, SandPointe, was established in 2013. We currently have 47 partners in the company, of which 13 are employee partners. Our 20-person staff is divided among 6 different departments. You can see the department groupings there. Currently, we have about $119 million under management in 53 accounts. We have about 50% of that is fund of funds, and you can see the rest of the information. So let's get right down to it. Where is the vol? What is the VIX doing this year? Last month marked the 12th consecutive month of positive returns for the S&P 500. Think about that in terms of history. Prior to that, when was the last time we saw 12 months of uninterrupted positive returns? Answer, it's been 67 years since 1950 that we've had a 12-month string of positive returns for the S&P. How many times in the last 90 years has this kind of an occurrence happened? Well, only 3. Once in 35, the time in 1950, and last month. Well, what about down days? This year, the S&P has been down more than 1% in a single day, only 4 times. Is this normal? And of course, the answer is not at all. Based on historical frequencies, we would have expected about 23 of these down days so far, almost 6 times as many, or a little over twice a month. And what about those 2% a day down days? We haven't seen a single one in 2017. Is that normal? And of course, the answer is no. We would expect to see 2% down days about 3% of all trading days, or 8 times so far this year. It's been over a year since the last one. Now, you have to put all of this into the context of the current bull market. Think about how long this market has been in a bull market. It's been 104 months now, or almost 9 years. This makes it the second longest running bull market ever. The longest being 113 months from the 1990s. Incidentally, the average bull market since World War II has only lasted 58 months, or less than 5 years. So the current bull market is about twice as long as the average, and only a few months less than the longest running bull market in history. If we can survive the next 9 months without a 20% correction, this will become the single longest running bull market in history. Now, in that context, you have to think about what's going on with volatility. As you know, realized volatility is the volatility of the S&P 500 that it actually realizes annualized over a single year period. Over the history of the S&P, realized volatility has averaged about 15%. So you would think of the S&P as having a given rate of return plus or minus 15%. Well, what has that realized volatility, the 30-day realized volatility, been for the S&P this year? And the answer is closer to half that, around 7. It's actually been around 5 since this summer, and is so today. What about the VIX index, or implied volatility? What is that average historically since 1990? And the answer is about 20. So you see, the implied volatility ordinarily, historically, averages about a third higher than the realized volatility, which sets us up for the trade, the risk premium trade. What is the VIX index average this year? And the answer is, again, about half the long-term average. Well, what does this really mean? Well, the implication is that not only has the VIX index been low this year, but so has market volatility in general. So what is the implication of this in the context of volatility space? Well, this is the big question. A lot of investors today are wondering whether shorting volatility, as SandPointe does ordinarily, is like picking up pennies in front of a steamroller. Some volatility investors believe the VIX index is mean reverting, and thus anticipate that it has only one way to go, up. Are they right? We think they are wrong. While VIX seems to be mean reverting over long time horizons, this doesn't necessarily mean the VIX is too low or that it will revert in short order. Other investors have suggested that the current low level of the VIX index has been fueled principally by market pressure from speculators shorting volatility instruments following the short the spike notion, thus causing the VIX index to be lower than it should be. Well, again, we believe this theory is equally flawed. According to Professor Dan Galai, whose early work on volatility measurements directly led to the creation of the VIX, he was quoted back in August as saying, the VIX is actually reflecting market expectations in the sense that people pay for the options, it's traded, and anybody can be on any side of the fence. It's doing its job of reflecting the market consensus going forward. The market's pretty efficient, and we have no reason to believe it's inefficient. So what does that mean for us? Well, it tells us there's not enough short speculators in the market to create the amount of selling pressure necessary to push vol prices low and actually keep them there for an extended period of time, as we've seen this year. So we come to a different conclusion. Our conclusion is it is not that the VIX is broken or not working as it should. Rather, our market is in an extended phase of unusually low volatility. Remember, October last month represented the first time in 67 years we've had 12 consecutive positive monthly returns for the S&P. Last time it happened was 1950. It's only the third time it's happened in history. Ultimately, this suggests that just because volatility is low relative to history doesn't tell us anything about where volatility is relative to current realized volatility. And right now, it's not low relative to current realized volatility. Again, recall the VIX index has averaged about 11 this year, but the realized volatility of the S&P has been closer to 7 and is today around 5, which is much lower than the VIX index would suggest is appropriate. So the big picture, we may indeed see continuing generous returns to shorting volatility given the right circumstances. Now, to address these circumstances in more detail, please allow me to introduce Trishul Patel, our Director of Research. Trishul is the co-portfolio manager of our all-season strategy, which showcases our VIX strategy. He was the former head of quant analysis for Regent Markets in Malaysia, where he traded proprietary derivatives with over $750 million in notional value across all products, including FX, commodities, indices, and stocks. Trishul, thank you for joining me.
Great. Well, thank you, Dennis, for the introduction. And thank you, everybody, for joining us today. Again, the big picture is that we don't think that the VIX index is too low or that the index is broken. Rather, we think that the index can stay low or even go lower. Thus, we still think that opportunities exist to make money in the volatility space, even at these low VIX index levels. So let's dig into the details. Over the next few slides, we will study how accurately the VIX index has predicted the 30-day out S&P 500 realized volatility over time. To do this, we will study the ratio between the VIX index and the S&P realized volatility. Typically, this ratio is above 1. And this means that the VIX index tends to overestimate realized volatility. This overestimation is known as the volatility risk premium, and it can be thought of as the excess premium that the buyers of insurance pay to the sellers for protection against market disruptions. What we will soon see is that the VRP ratio has been very healthy this year, as it has been over long periods of time, even though the VIX index has been low this year. So, for a strategy like ours, this represents a great opportunity to be short volatility. In this first chart, we see that the blue line represents the VIX index, and the red line represents the actual realized volatility of the S&P, basically the standard deviation of the S&P over time. And what we see is that about 85% of the time, the blue line is above the red line, as noted by the shaded gray area in this chart. It's important to note that even this year, the blue line has been healthy and above the red line, even though the realized volatility of the S&P has averaged about 7%, and as Dennis mentioned, about 5% recently. So, to make this point a little bit more clear to understand, let's look at the actual ratio of the volatility risk premium over time. The first thing to notice on this chart is that that ratio has been above 1 almost all the time. As we had mentioned in the previous slide, that's about 85% of days. The average of this ratio is about 1.4 for this period, meaning that there's been a healthy amount of premium almost all the time in relationship to the VIX futures and VIX index, that is, being above the realized volatility of the S&P. Now, to smooth out the noise, we're looking at the 30-day moving average of this ratio, just so that we can make our point a little more clearly. And if we look at this year, we see that the ratio has been especially rich, even though the VIX index itself has been low. What does this mean? Well, this means that it's been a great opportunity to be short volatility. And that's what we're actually going to look at with respect to our returns. So what does this mean for a strategy like ours? Well, as we have noted, when the VRP ratio is above 1, there is an excess premium, and a strategy like ours tends to have a nice positive return. In fact, the higher that ratio goes, the better we do being a short volatility manager by opportunistically shorting volatility. So this year, that ratio has averaged about 1.7, which is again higher than the long-term average. And it's important to note that even now, that ratio has been above 2, which is the 10th decile of observations. You note from this chart that we average about 23 basis points of return a day when we happen to be in this particular range. Finally, not to put too fine a point on it, but we happen to invest in the VIX future, not the VIX index itself. However, if we look at the volatility risk premium ratio based upon the VIX future divided by the realized volatility S&P, we see that a similar pattern emerges, but the premium based upon the VIX future is even higher. This shows that there's ample opportunity for a strategy like ours that invests in the VIX future to generate returns opportunistically. Thus, looking at our returns over this year, we're up about 10% net, which is about 14% gross for this period this year, and about 18% last year. This translates to an about 19% annualized return net of 2 and 20, with a healthy Sharpe of about 1.3. What this means is, in an environment where many other quantitative managers have struggled given the low volatility, we've seen that we've been able to generate a return that's pretty good. So, with that, I'll pass it on to Dennis, who will provide a conclusion. And thanks again.
Thanks, Trishul. I really appreciate your help here. I promised you that I would give you the top 3, and at the beginning I gave you the top 2. And now this week's number 1 volatility joke. This is volatility manager joke. What's the difference between a bad volatility manager and a cheap divorce? Answer: there's no such thing as a cheap divorce. Well, our conclusions today are yes, volatility is low, but no, that does not necessarily mean a spike in volatility is more likely. It does not necessarily mean that by shorting the volatility future, you are picking up pennies in front of a steamroller. We believe opportunities, rich opportunities, are still available for strategies in the volatility space. And we would encourage you to look into whether or not they make sense for you as part of your portfolio at some level. These tend to be highly uncorrelated strategies with return streams that will be diversifiers for most institutions. Once again, this is SandPointe Asset Management. We very much appreciate your listening and your attendance. We will send you a copy of these slides today, and we appreciate your attendance. Thanks, and have a great Thanksgiving. Bye now.